Hello, everyone. Welcome to another edition of Tip Tuesday. Jeffrey Nance here with you. And we have been talking about things that we love about trading. And today is going to be a session called I Love It When a Plan Comes Together. And when I hear that, I don't know about you, but I go to the A team. So back when I was growing up, you're watching the A team, watching the cartoon and stuff. I love it when a plan comes together. And most of the time, the plan was kind of like all over the place. Like sometimes it would work like they expected, but pretty much the funny part of that was that it rarely went like they had planned. But in the end, it worked out. So hey, it was a good plan. So it's trading like that where we kind of have a plan, but we don't really know whether it works out like we planned till the end or not. So we're going to talk a little bit today about what makes a good plan. So how do we know if a good plan comes together? Well, first off, we have to know if we have a good plan. So what's the process? Well, first thing we're going to do is we're going to try to understand the market. Well, in particular, right now at this time, on here we are on 2/2/22, by the way. So it's Tuesday 2/2/22, which I think is pretty cool. And we're talking about what does it mean to have a good plan. Well, the S&P is kind of a little volatile right now. So there's some rumors of war with Russia and the Ukraine, and that's causing some uneasiness. It's impacted our market, but it also is at a time when that makes sense for the market to be dropping. So it's fine that it is. But we're also, at least today, we got really, really close to a point at which the S&P might find support. So what's the process now for kind of understanding what would go into making something a good plan? Well, the first step is to understand what the S&P is doing. So let's just start with that. So if my plan is to understand what the S&P is going, I've got to go and look, obviously, at a chart and figure out what it's doing based on the patterns that I've been taught. What do I recognize about what's happening here? How do I think through what I expect to see and what that might look like? And then once I figure that out, then I go to the next step. Now I'm going to go into a list and I'm going to go pick a stock that I think is at a great buy point. So I have an idea of where I think the stock is going to go, how long it might take to get there, what that range might be on the scale. It might move from like 20 to 22 this week. I may be expecting like a big move for that stock because that'd be a 10% move. Or maybe I think it's going to move like 50 cents, or maybe I think it's going to move $1 or something like that. So I'm figuring that out. And then the next step is once I feel like I've got market tone and I've got the technicals lined up with a fundamentally sound stock, then I'm going to go in and I'm going to purchase. Now, the next part of this is going to vary from one person to the next because depending on your level of education and what you feel comfortable trading, at step one, it might be just simply buying the stock. I'm just going to go buy the stock and buy X amount of shares. So that might be the next part of the equation is okay. So if you're just trading step one, where you're just going to do stocks, then your next step for you is just figuring out, well, how many shares am I going to purchase on this stock at this time? If you're doing step two and now you're trading options, you say, well, I think it's going to go up. So you're going to be using a call. If you're applying the step two criteria, then you're out there. And the next step for you is just to figure out, okay, so how do I do the ratios that we're looking for at step two? And then, the timing things, you go out there, you pick that option. And then the next step, but again, would be how many contracts am I going to purchase? So step three, now you're saying, all right, it's a bullish play. I'm going to go with the bull put. What does that look like? What do my strike prices need to be? What gives me adequate protection here? If cushion is going to be part of your factor, you're going to enter that information as well. That'll be part of your process. And then selecting those multiple legs of that particular trade setup. And then, of course, if you're doing a debit spread, now you're looking at it going, all right, so here is where the stock is. Here's where I think it's going to go. And as I said many times on Market Corner 4, I think two keys to being a really proficient debit spread trader: how much is the stock going to move, in which direction, and how long will it take to make that move? So you're looking at those things. And again, now you're going in there realizing that you have a lot of leverage through the trade setup itself. How many contracts of this thing am I going to purchase? Now, The next part of the process is then watching it. Okay. So either we enter it that day, we watch it, kind of see what it's doing, if it's going our direction or not. And then we are going to see the next day, and then possibly the day after that, and maybe several more days in a row. But how do we know if something is really a good trade? How do we know if a plan comes together? Well, one of the definitions that David uses at step 2 is, he said, a good trade is when I had a reason to do what I did based on the potential return and the amount of risk that I was willing to take, and then I did what I predetermined to do. So let's kind of break that down, because that's going to be the next big step in our process here, determining whether or not this plan really did truly come together. So I looked at the play, all right, and I'm trying to decide, all right, based on the potential return, is the amount of risk that I'm taking worthwhile? So let's just say that I'm willing to pay or to have an expense. So let's just say I'm willing to have an expense of maybe 50 cents a share. Well, if that's the case and I could lose 50 cents a share, then I certainly better be in a position to anticipate that trade could make me more than 50 cents a share. I would say, now again, this is a personal preference, but I would say that you need to plan to at least be able to make at least a dollar out of that trade. So if you're going to put in 50 cents, at least think that it can potentially bring you the profit of $1. Now it could be 2, 3, way more than that, 5, 10, 15s, 20s, whatever. Point is, right, if you're going to say, well, I'm in a trade and I'm willing to lose $2, make sure that if you're going to be willing to lose $2 a share, that you're going to at least make that. So that's how you're kind of determining that risk return. Now, most of the time, guys, you're going to get a much higher risk return probability if you simply have a better buy point. So if you simply have a better buy point, that's going to help you, because now you have a greater distance between like where you're buying and where the stock might go. So that's a higher profit potential. And then if this really is your support area and it drops below that, then you're going to stop out. So the real key, because you can do a calculator and you can do risk return, but the point is this simply, do I have the potential to make more than I should lose with a good stop out? And most of the time that just simply comes down to a buy point. So if the stock's already moved up for like 3 days, probably not a good buy point. And it's not that it won't move up for another day or 2 or more. It's just you're not getting an ideal buy point at that because you're about 3 days late. Same thing for when it drops, particularly I would say when it does drop, because now we know that when stocks drop, they tend to do so quickly. And it's not a good idea to get in late, because now you're getting in late and it's say 2 or 3, 4 days late. And now it's dropped so much that it's about to hit support and go back up. So the key to entering into a trade with an acceptable risk really does boil down to those better buy points. So if I get a better buy point, I have a higher profitability potential, but I also have a smaller stop out in case the stock does move against me. So then the next part of this whole thing is, once I've determined whether or not the risk is acceptable based upon my potential return, is you'll notice that we said, and then I did what I predetermined to do. So it's at this point, guys, in order for a plan to come together, we have to have had a plan, right? So I can't do what I predetermined to do if I didn't predetermine anything. So what do we mean by this idea of predetermining what I'm going to do? You need to have a firm stop out in mind. So just because you got into the play doesn't mean it's going to work. Just because you got into the play doesn't mean it's not going to work, right? So we understand that we're taking a risk here. It's trading, right? But we're doing it based on patterns of predictable, repeatable, and reliable patterns. But we still understand that there are reasons why the stock might move in a direction that's different or opposite of what we anticipate. Most of the time, probably market tone related. If not market tone, then it may be industry news related or something specific to that stock. So otherwise, most of the time it'll move with us. So if something does go, opposite, it's market tone, industry related news, stock related news. Otherwise, it should pretty much do what we anticipate it doing if everything else is lined up. So then how do I know if what I predetermined to do? Stop out. You got to have a firm stop out in mind. Right. So if the stock breaks this EMA, I'm going to stop out. I'm going to take an expense, but I don't want to have a bigger expense. You say, well, I might use the David Mitchell advanced stop out. Okay, so what does that look like? So it drops below it today, but what does it need to do tomorrow in order to meet those criteria if you're going to stay in? So one, you got to have your stop out. And then number two, you got to have a profit target in mind. So whether that's an actual price point on the chart where you think the stock is going to go to this price, or whether it's a percentage. Hey, once I make 50% profit, I'm willing to get out. Once I make 100% profit, I'm willing to get out. Once I make, whatever. If there's a number in your brain where you say that's my target, well, if that's what you predetermine to do, and then you do it, then by definition, that becomes a good trade. Notice, guys, that David says there in the last thing, and this is true whether I have a small expense or a profit. And it seems weird to think that a plan comes together if I have an expense, but the reality is if it moves against me and I stopped out, then indeed I followed my plan and I had a small expense, I can move on to the next trade. If it works out the way that we want to, which is what we all desire, right? That at the end, I look at a trade, I executed it when I should have gotten in, I got out when I should have gotten out, and I made a profit. Yeah, that's what we want, right? That's what all of us really want out of a trade. And that's when most of us say, well, hey, that plan really came together. But the reality is, guys, if you've done everything we've talked about today, even if you have an expense, you could have had a plan that all came together. Now, it may not be the result that you desired, but as long as you're creating good plans and you're executing those good plans, remember, you're setting yourself up to be able to trade for a longer time. And if you can do the right plan with the right execution long enough, then hopefully you'll be in a place where the results will then follow, and they'll be the results that you desire. So we love it when a plan comes together, guys. I want to encourage you to have a plan. Don't just willy-nilly go into a trade and go, hey, this one looks good. Oh, I hit some buttons. I let my cat walk on the computer and my cat got into a trade, so we'll just see how it goes. No, let's have a plan and let's get ready to see that plan come together. Well, that's our tip for today. Thank you for joining us, whether you were live with us or watching this later. Thanks for being a part of Tip Tuesday.